Alright, welcome back. In this video, defining profit. Let's do it. Alright, so let's define profit, since that's what I said we were going to do. Profit is total revenue minus total cost. So that's it. We consider their total revenue, which was price times quantity, so the price times the number of units sold, and then we subtract their total cost, and what's left over is a producer's profit. Now, we need to consider how we calculate those costs, since we've already done revenue in the past. Well, we have two types of cost. The first cost is known as an explicit cost. This is a cost that requires a payment. So this means that somebody is paying somebody else money. These include things such as wages, rent, physical capital, so machinery and tools, materials, inputs, all of those sorts of things. So anything that you pay another person for, you have to write them a check, give them money, that would be an explicit cost. Implicit costs, on the other hand, are different because these do not require a payment. So in this case, there's no money changing hands. So a lot of times, non-economists don't really consider implicit costs, but economists do because they represent the opportunity cost of using resources owned by the firm. So the idea is that if instead of, for example, using the building that you own for your small business, you could have rented out that business, or you could have rented out the machinery to somebody else. You could have gotten paid for the rent value of that machinery or of that building. And so that is an implicit cost to you, because instead of doing what you have chosen to do, you could have gotten other money. So you have this line here, it says it is measured by the dollar value of benefits that are foregone. Another example could be about a person. So a person decides to open up their own business, but an implicit cost to doing so is that they could have gotten another job somewhere else. They could have earned a salary working for another company. So that money that they are giving up, that they could have earned with their personal resource, their labor, their human capital, that is an implicit cost. So again, economists are going to view this as a very important type of cost because, well, it's that opportunity cost. It's what did you give up to be able to use this machinery, this tool, this labor, this building. So implicit cost, very, very important concept. Accounting profit. So the way an accountant would calculate profit, they would just look at total revenue and they would subtract explicit costs and depreciation. Depreciation is the decrease in value to your machinery, your tools, that kind of thing. So as they get older, the value of them decreases. So that's depreciation. So accountants would take into account the fact that your machinery is becoming worth less over time. And they would also take into account the cost, the explicit cost that you pay to somebody else, and that's it. And everything left over would be an accounting profit. Economists, on the other hand, are going to also consider the implicit costs. So the economic profit is going to be total revenue minus the opportunity costs of the resources, which include both implicit and explicit costs. So total revenue minus implicit and explicit costs, and that includes depreciation. Depreciation will be part of an implicit cost. So I'm not leaving depreciation out. It is still part of this for economic profit as well. All right, so we are left with something known as a normal profit. And when we start getting into the later parts of this unit and future units, we're going to understand why it's called a normal profit. But it is an economic profit equal to 0. So that is known as a normal profit. Because remember, we're not just thinking about the accounting profit. We are including the implicit costs. So what does it mean to have an economic profit equal to 0? It means that all of your costs, both explicit and implicit, are covered by revenues. What that means is that you are making enough money that there is nothing better you could do with your resources. So for example, just to give you a couple of numbers as an example, you have a business and that business earns $100,000 in total revenue and they have $50,000 in explicit costs. And if you didn't have this business, you could have earned a salary of $50,000. So your economic profit would be 0. It'd be 100,000 minus 50,000 minus 50,000. Normal profit of 0 in this case, which means that you couldn't use your own labor and your own resources any better than you currently are using them. This has been a La Money production.